The Fed's latest beige book dropped this week, and buried inside the regional anecdotes is a signal that should give every investor pause. The one bright spot for consumer spending was a soccer tournament. The World Cup delivered a measurable, if temporary, lift to bars and restaurants across Fed districts. But here is the critical detail. That boost was narrowly contained and failed to translate into any broader consumer momentum. In a healthy economy, a major cultural event accelerates existing spending trends. Instead, the Fed's own regional contacts described a consumer who needed a spectacle just to show up. That is not resilience. That is a warning. The Federal Reserve's beige book, its qualitative survey of economic conditions across all regional districts, explicitly noted that bars and restaurants received a temporary boost tied directly to World Cup soccer viewership. That is the headline the bulls wanted to run with. But the full picture is considerably more sobering. The beige book made clear the gain was event-dependent and did not reflect underlying structural demand. Businesses outside the food and beverage corridor reported continued caution from consumers. Against a market backdrop where the S&P 500 sits at 7,507 and growth stocks are showing weakness today, this kind of cautionary anecdote from the Fed carries real weight. Here is the macro transmission mechanism that makes this beige book passage so consequential. When consumer spending can only be animated by one-off cultural events rather than sustained income confidence, it tells you the underlying demand engine is running on fumes. The Fed surveys business contacts directly. These are restaurant owners, bar managers, and retail operators speaking frankly about what they are seeing. Their message is that outside of the World Cup window, traffic and spend remain subdued. That dynamic reinforces the thesis that the consumer spending cycle is maturing or contracting, which feeds directly into slower GDP growth expectations and raises the probability of Fed rate cuts sooner than previously priced. The immediate casualties are in consumer discretionary. Faces headwinds because this data confirms spending is episodic, not structural. Specific restaurant names carry concentrated risk. McDonald's and Starbucks have leaned into traffic recovery narratives that this beige book directly challenges, while Darden Restaurants, parent of Olive Garden and Longhorn, is acutely exposed to any softness in casual dining demand outside event windows. Defensives flip the script. Consumer staples outperforms as investors rotate towards staples on flight to quality logic. Meanwhile, the rate cut narrative benefits bonds. The 10-year Treasury yield sits at 4.57% today, up 0.53%, but the beige book's tone argues that yield has room to fall as growth expectations reset lower. There are three levels every trader needs to anchor right now. First, the 10-year Treasury yield at 4.57%. A clean break below 4.50% would be the technical signal that the bond market is pricing in a growth deterioration consistent with what the beige book described. Second, the VIX at 18.13, up 8.37% today, is showing an uptick in hedging demand but has not reached panic territory. Watch whether it closes higher, which would accelerate defensive rotation. Third, growth stocks are already showing weakness on the session. If growth premium continues compressing on weak consumer data, they test support levels, pulling discretionary and growth names sharply lower with them. Strip away the World Cup noise, and what the Fed's beige book delivered is a clean, unambiguous signal. The American consumer is event-dependent, not momentum-driven, and that distinction matters enormously for portfolio positioning. Overweighting cyclical consumer names like McDonald's, Starbucks, or Darden Restaurants on the assumption that restaurant traffic has structurally recovered is a crowded and now challenged thesis. The data validates rotating toward consumer staples, extending Treasury duration as the 10-year yield trends toward 4.50%, and treating precious metals as a legitimate macro hedge rather than a speculative trade. That is the single story driving markets today, and the full breakdown is up for anyone who wants to go deeper. If this kind of deep dive market analysis is what you come here for, hit the subscribe button right now and turn on the notification bell so you never miss a breakdown. Every trading day, we cover the stories that actually move your portfolio, the Fed signals, the sector rotations, the key levels, all in one place. See you tomorrow.